Today, we're diving into one of the fastest growing trends in personal finance and youth investing culture: stock market simulators. These digital platforms allow users, particularly Gen Z, to practice buying and selling stocks, options, and other financial assets with fake money while watching real-time market movements. On the surface, it sounds like the perfect training ground: lower risk, lower losses, pure learning. But beneath the appealing surface lies a deeper question. Does practicing with fake money truly prepare young investors for the real financial world? Or does it create unrealistic expectations that could shape an entire generation's relationship with risk? To understand this, we need to examine how these simulators work, why they become so popular, how they're influencing financial behavior, and what researchers and educators are saying about their long-term effects. Like many tools in the digital era, they offer valuable benefits, but also hidden pitfalls. As we explore the world of Gen Z simulated investing, we'll see how a seemingly harmless learning tool may have more psychological impact than most people realize. Let's begin with the basics and work our way deeper. What exactly is a stock market simulator? A stock market simulator is a digital platform that mimics the real behavior of a financial market. That includes stock prices, trading hours, bid and ask spreads, volatility, and even the execution speed of trades. Users are given a virtual balance, often something like $50,000 or $100,000 of fake cash, and are let loose to trade real assets in a live pricing environment without risking any actual money. It's the evolution of something much older. Before digital platforms existed, investors who wanted to practice used a method called paper trading. It was a simple idea: write down a pretend trade on paper, track the stock's movement, and record whether your pretend purchase would have made or lost money. It was manual, slow, and often inaccurate, but it helped new investors build basic pattern recognition skills. Today, paper trading has transformed into something dramatically more accessible and appealing. Apps like Webull, TradingView, Public, and even brokerage platforms that traditionally require real deposits now include built-in simulators. Some apps allow simulated trading of not just stocks, but options, futures, crypto, and advanced order types. These are features once reserved for professionals. What makes these simulators wildly popular is the seamless integration into apps that also handle real money. A user can click a button to switch from a simulator portfolio to a real trading account instantly. There is no longer a barrier to entry. The friction is gone, and for a generation raised on devices, the interface feels intuitive. Now, simulators are no longer tools for hobbyists or aspiring traders alone. They've become mainstream, stitched into the culture of financial literacy programs, social media investing communities, and even school curricula. That's the environment Gen Z is growing up in, a digital ecosystem where investing feels approachable, game-like, exciting, and accessible without risk. Why Gen Z is turning to simulators in record numbers? There's a reason simulators exploded in popularity among young users. Several modern forces collided to create the perfect environment for practice-based investing tools. Let's break these down one by one, because together they illustrate why so many young people are flocking to these platforms. First, there's affordability. Many Gen Z individuals are entering adulthood in an era of high living costs, student debt, and stagnant wages compared to previous generations. The barriers to building wealth through traditional investing feel higher than ever. When young adults don't have excess income to risk, simulators offer an appealing alternative, a chance to experience the world of investing without needing capital. Second, financial culture has shifted. Social media platforms like TikTok, YouTube, and Instagram have created an entire ecosystem of financial influencers, stock trading personalities, and investing challenges. Clips of traders showing big wins, whether real or simulated, have made the idea of trading feel exciting and adventurous. Some influencers actively encourage viewers to practice trade first before using real money, which pushes millions towards simulators as their first exposure to financial markets. Third, these tools provide hands-on learning. For many young investors, finance classes, if they had them at all, rarely covered real-world market mechanics. Simulators fill that gap. They help users learn order types, portfolio management, diversification concepts, and the rhythm of market hours. Some users say they became comfortable with terms like limit orders, stop losses, volatility, and bid-ask spreads long before ever touching real money. There are also psychological motivations. Gen Z is a generation used to simulation, from gaming environments to virtual learning. Practicing skills digitally before trying them in real life is normalized. Think about how driving simulators, language apps, and online learning have shaped how young people approach mastery. Simulated investing fits perfectly into that mindset. Finally, simulators offer an emotional cushion. Fear is one of the biggest barriers to investing. The fear of losing savings, the fear of not understanding the rules, the fear of making a mistake with long-term consequences. Fake money removes that emotional barrier. Suddenly, the user feels free to explore, experiment, and take risks they would never dare take with their real bank account. Together, these factors explain why simulator usage has skyrocketed. Some platforms report that Gen Z paper trading activity more than doubled in recent years. With more young people delayed in investing due to economic constraints, simulators feel like a low-stakes entry point that offers confidence building without financial danger. But with rising popularity comes growing scrutiny, especially as experts begin asking whether fake money training truly reflects real-world investing. The hidden risk, gamification, and behavior distortion. This is where the story becomes more complicated, because simulators don't just teach mechanics, they influence psychology. And psychology is the core of financial behavior. One of the biggest criticisms from researchers is that simulators remove the emotional weight of real investing. When money isn't real, the fear of loss disappears. The tension that makes real-world decisions difficult is gone. And that lack of emotional consequence leads to behavior that does not match how people act in real markets. Many users openly admit they take massive risks in simulators that they would never take with real money. They buy high-volatility stocks, trade options aggressively, chase trends, and gamble on short-term fluctuations. Why? Because there's nothing to lose. If the fake account goes to zero, you simply reset it. There's no pain, no financial setback, no shame. Data from simulator platforms shows a striking trend. A large portion of simulated trades involve options, which are complex and risky instruments even for experienced investors. It reflects a behavior pattern closer to gambling than long-term investing. This is where gamification becomes dangerous. Simulators often look and feel like video games. Colorful buttons, live charts, achievements, leaderboards, and instant feedback. That design is meant to enhance engagement, but it can also distort user perception. If massive gains come easily in a simulator, it creates unrealistic expectations about the real market. If losses carry no sting, it normalizes risk-taking behavior. Educators warn that simulators might unintentionally teach the wrong lessons. Students may focus more on the thrill of big wins instead of the fundamentals of long-term investing. Platforms reward short-term thinking, high-risk maneuvering, and fast-paced trading, all behaviors that differ dramatically from how actual wealth is built. The psychological gap between simulated and real investing can create overconfidence. Users who succeed in simulation environments often believe they have mastered the market. That confidence disappears the moment real money is on the line. Fear comes back, hesitation returns, and sudden losses can feel devastating. This emotional mismatch is one of the biggest pitfalls of simulators. They prepare young investors for mechanics, but not for the internal discipline, stress tolerance, and emotional volatility that define real-world financial behavior.